Hi, everyone. My name is Blair Pierce, and I'm the Director of Operations at Think Realty. I have a couple of quick announcements that I would like to share before we get into the webinar today with Damon Riehl with loanbids.com. First off, Think Realty, we just launched our brand new membership. It's called Think Realty Plus. Think Realty Plus, it gets you pretty much everything that we have to offer, including exclusive virtual events, publicity opportunities, advertising, trusted partner discounts, free live event tickets, Think Realty magazine delivered to your door every other month, and a lot more. So with our launch, for a limited time, you can get Think Realty Plus for only $14.99 per month. All you need to do is go to thinkrealty.com and put in the coupon code LAUNCH when you sign up, and you'll receive that price. Also, we just announced our virtual REI Summit, which is going to be taking place on July 31st through August 1st. And this virtual event will provide everything that you need to navigate your election year investing strategy. Tickets are only $24.99, or they're also complimentary if you actually sign up for our Think Realty Plus membership. And all that information, of course, can be found on our website, thinkrealty.com. For the webinar today, please use the question box to ask any questions that you may have throughout the webinar. Damon will get to those at the end. And with that, I'm going to hand it over to Damon with loanbids.com. Thanks, Damon.
All right. Thank you, Blair. I appreciate the opportunity to talk to all of you folks. I understand that there are a significant number of real estate investors and probably a few lenders on the line as well. So I'm going to share with you a little bit about LoanBiz, what we're doing here, and I'm going to particularly spend time on a little bit of education information on the private lending market and helping you navigate the various aspects of this very broad thing called private lending. So with that, I'm going to take a minute and I'm going to launch my presentation here and share that with everyone. All right, hopefully everyone can see that.
Looks good.
And what I'm going to do first of all is give you an idea of who the heck this guy is on the webinar and what we're doing, and again, who I am. So this is a little bit about myself. Been married 40 years. I'm the father of 3 daughters. You see in the bottom, I'm papa of 5 grandchildren. We, have a lot of fun with the kids. I'm a graduate of the University of Missouri Columbia. Grew up in the St. Louis area, and I actually got my MBA from Lindenwood University in St. Louis. So I currently live in the middle of the country in Springfield, Missouri. It's a growing college town, and we moved our company here a few years ago to take advantage of the talent pool here and also to be closer to grandkids. I've got 41 years of experience in the private lending and the overall mortgage lending space. So I've been fortunate enough to have entrusted in me the ability to build lending platforms. So through my career, I've been able to build 7 lending platforms, primarily focused on new construction or renovation. So it really fits for what we do here. I've held leadership positions at some of the biggest companies in the world: Citibank, GE Capital, spent time with Fannie Mae, BMO Harris Bank, and Ocwen, who is a large mortgage servicer. So from an interest standpoint, I love a good top shelf bourbon. I grow hybrid tea roses, and I'm a big English Premier League fan, where I support Chelsea, and I like to golf occasionally. And most importantly, my wife, she is a romance novelist. We're actually getting ready to go down to the Dallas area to one of her conferences where there'll be thousands of enthusiasts in the romance world. That's a little bit about myself. So again, a little bit of background. So hopefully, as we go through these things, you can see that some of the experience might shine through and give a little bit of credibility to what you're going to hear. So I guess the first question many of you have is, what the heck is loan bids? I've seen it, maybe I've seen the logo around. What is it? So loan bids is really a nationwide business purpose mortgage platform. So what we do is we are not a lender. We are essentially set up as an exchange, or with many of our lenders, we're set up simply as a wholesale commercial mortgage broker. So with that, it enables us to be able to have some of the things here on the slide here, which talks about our secret sauce. The fact is that we've got market leading options. We do a lot of volume, and with the lenders that we work with in the private lending space, we generally get their best pricing. So in many cases, we can actually provide better pricing than they would directly if they were to connect with you as a real estate investor. We also have a unique position in that we can be your trusted advisor as a real estate investor. We become kind of your finance team. So you'd be paired with an account executive and a transaction manager that, regardless of which lender is selected for that particular loan transaction, you get a consistent experience across whichever lender in the private lending space you choose. We also help reduce the paperwork hassle. And we do that by, once we've done a single transaction with you, we've got most of the paperwork. We have many clients who come back time and time again and work with their account executive, and they just give them an address and send over a purchase contract, and we're off to the races. Makes life a lot easier for our real estate investor partners. As you can see here on the slide, we are also a lender on the Connected Investors platform. We work with them quite often on clients that come through their platform, and we are a featured lender on Bigger Pockets. So again, those particular entities have trusted us with their clients, and we've had a multi-year experience with both. So on our platform, as I mentioned, we have a lot of lenders. This is a small cross section of what you would find if you came to our loan bids platform. So you would work with an account executive, you would talk to them about the particular loan transaction, and they would determine which lender is the best fit for that particular scenario. And because we are very adept at all of their underwriting guidelines, sometimes we even know their programs better than their own people do. So we're able to fit your request into the right lender at the right pricing, at the right loan amounts, and that benefits you greatly. So again, you don't have to shop the market. We shop, and you get the savings from that. So let's talk a little bit about our clientele. The majority of the investors that we work with are involved in the BRRRR strategy. But as you can see here on the slide, most of them don't have an endless supply of capital. So some use equity, but more than most use a debt instrument like a short-term loan for a fix and flip, and a long-term loan, which typically is a DSCR loan for many of our customers. So I'm going to spend time talking about how to position yourself to get the best deals in each of these areas. Plus, I'm going to talk about some special features that you may not even be aware of that are available on these types of loans. So one of the things that we've learned over time is that our borrowers have pretty common requests. And if there are any lenders that are on this particular webinar, you might take note of what I'm going to go through right now. So the majority of our clients are really interested in, first of all, the lowest rate and fee combination for the property that they want to finance. Most of them want the least amount of their money tied up in the deal as possible. They want a low hassle process. They want great communication. They want to close when they want to close, right? And they don't like late surprises. So this is intuitive for many of the lenders that are out there, but you're a lender and you can focus on these 6 things, you can really grow your business. So again, I'm going to talk about these a little bit further, but as an investor, you can probably relate to many of these particular items that are on the list, and think about transactions you've done in the past with private lenders, and some that are good in some of these areas and some that aren't so good. So let's talk about the deal factors for a great fix and flip loan. And as a real estate investor, across our platform, the biggest factor in getting the best fix and flip loan transaction, which meets those requirements we talked about on the last slide, is really number one is your investing experience. So let's talk about it. What does that mean? So lenders on our platform have varying requirements as it relates to experience, but almost all of them have a situation where the more experience you have, the more they will lend, meaning the less in your pocket, and they also will give you the better rates and fees typically as well. So experience is a number one thing. So let's talk about what that means. So lenders on our platform categorize it differently. So some of them will look at a 3-year period of time and say you have to have a certain number of rehab completions in that particular time frame. So some are 2 years, some are 3 years, some are your lifetime. So knowing that's important. The other thing is that some of them will accept alternatives to actually completed rehabs. Some of them will simply say, I'm going to give you a credit if you have just a rental. Maybe you didn't do any rehab on it. I'm going to throw in, a credit for that towards your experience requirements. Some of them give credits for having a real estate license. Other ones, if you've got a general contractor's license, they will give you credit. But the number one thing to getting the best rate and the highest loan amount is how you go about proving your experience in this transactions. Let's talk about that for a second. The easiest way to do that is to keep your HUDs from your closings when you refinance that loan into a permanent loan, or when you sold that particular rehab fix and flip off. That's the best one. However, some will accept reports that we can pull through services like CoreLogic, where it shows that you are actually had ownership interest in a certain property. So again, there's variances there on how lenders accept proving that experience. So again, we navigate that for you, and as our account executive has a discussion with you, he'll bring that up, saying, you say you've done 5 in the last 3 years. Let's talk about those. How did you sell them? Did you keep them? What happened? So again, so that they know before they say, okay, lender number A is the best, they know that deal will fit. So long story on experience, but that is a number one for fix and flip and new construction loans. The second important criteria is having ample liquidity. And what I mean by that is really excess liquidity above and beyond that cash you need to close on that transaction. So if you've got a fix and flip loan that's 90% of purchase and 100% of the rehab, in that particular area, you're going to be bringing in 10% plus the closing costs. And many lenders are going to look for you to have some of a safety net, so that if your deal somehow has a cost overrun or gets delayed, that you still have enough of a safety net to be able to make interest payments during that particular time frame and get to the completion if you have to pay more for materials. So, and the third item is really, having a decent credit score. I'd say good on this particular slide. Fix and flip is less dependent upon the credit score for pricing. Sometimes if you go below a certain level, your loan amount will be reduced. So we have some lenders that, if you drop below 680, they will cut back your leverage from, call it 90 to 85 or 80. So again, credit score might play a little bit into your cash to close requirement, but typically you can get a loan approved with similar rates and fees. Okay, so 3 things for a great fix and flip loan: experience, liquidity, FICO score. All right, so let's talk a little bit about what the typical short-term loan structure is and what it looks like. So in today's market, so on a 1 to 4 unit property, I'm going to leave 5+ units out for this time because they're a little bit more conservative. But for a 1 to 4 unit residential property, most of our clients can get a 90% of purchase, 100% of rehab, 75 ARV loan. We do also have a few what I would call 100% options: 100% of purchase, 100% of rehab to a 70 ARV. For those of you who know, that's the after repaired value. Typically, those 100% options, if that's what you like and that piques your interest, those come with a little more underwriting. They're going to make sure you got more experience, like we talked about on the last slide. They're also going to be more underwriting. We have one lender that does 100 that's going to look for 2 years tax returns. Okay, so yes, you can get it. Sometimes it comes with a little bit more underwriting. If you're okay with that, great. We've got it. Again, it's all about trying to size in what your needs are and being able to give you the best fit. So let's continue on. So the typical structure of a fix and flip loan is anywhere from 6 to 18 months, interest only. So there's no principal payments during that term. Most of the time, there are simply interest payments. From an experience standpoint, the majority of the lenders on our platform look for around 2+ experience in the last 3 years. That's the majority of them. But we've got 90%, loan to cost options available even for first timers. So if you're a first timer, don't let that scare you away. Again, we can try to fit you into one of those particular options. The interest rates during that term typically range from 10 to 13%. So if you think about short-term rehab loans, one of the things that investors don't really understand when they think about their overall cost of financing is how fast they will exit that particular loan. We have many light rehab deals where the loan is made and then 3 months later they're all ready to refinance it into a long-term loan, or they're ready to sell it. So in that particular case, I call it a 12% rate is 1% a month. So if you only keep that loan outstanding for 3 months, it's really just a 3% charge, 1% a month before you've exited. You won't have the full 12%. But again, that is if you keep it for the full 12-month term. The next thing is lender points. That's always an area which is really important in a short-term loan. Probably the 2 most important things we hear from clients is, again, least amount of my money in the deal and how much are your fees. Because interest rates, as I just described, seems to be a lesser concern because you only have it for a short period of time. So typically, with our lenders involved in the transaction and even our exchange fee included, you're typically looking at 2 to 3 overall lender points with a particular transaction. And that's, those are the overall cost based upon the loan amount. The next thing is lender fees. Most of the lenders on our platform, in addition to the interest rate, are going to charge, some call it processing fees, some call it underwriting fees, some call it other things, but all in all, they're typically charging about $14.95 to $18.95 on every transaction that you bring in. So, for smaller transactions, that's become more meaningful. For larger transactions, it's less meaningful. So, on top of those charges, you also will pay for evaluation, whatever that is. Could be a full appraisal for some of the lenders. Could be title. It's going to be title charges and then closing costs from the title company that you select. So again, giving you an idea to kind of see what the cross section of lenders look like from an overall cost standpoint. So another thing is here we talked about earlier, minimum FICO score to kind of get the best deal is around 660. Once you drop below 660 FICO score, your loan to cost typically start dropping down. We can do 80% loan to cost down to around 620 credit score. And one of the services that we also provide to our clients is the ability to do a soft pull of your credit report at no charge. And we have another tool. Let's say you are 10 points away from the FICO score that gets you the loan amount that you want and the rate that you want. We have a tool called Wayfinder, where for our clients, again, free of charge, we can give them the specific things to do, such as paying down certain credit cards by a certain dollar amount that will then elevate their credit score to that level that they are wanting. So it's pretty precise and it works pretty well. Sometimes it takes a month for it to show up, but it can help get you where you want to go. The next item is really liquid assets. For a short-term loan, the majority of our lenders are going to require anywhere from 3 to 6 months worth of excess reserves or excess liquid assets, plus about 10% of whatever rehab budget you have on that particular transaction. So again, for you to think about, getting that together before you apply makes sense. Do we have lenders that don't require this? Yes, we do. Some of them might be slightly more expensive in other areas of rate and fees, however. So again, I'm giving you kind of a cross section of what the majority of lenders are looking for. The next is a minimum initial advance of $50,000. Well, why do I bring this up? So we have many clients that will come to us and say, you know what, I bought a property 2 years ago and it's free and clear, and now I'm ready to rehab it. So, I just need the rehab funds. I don't need, money toward the house. And so there are some lenders that don't like opening up a loan with a zero balance on it and waiting for you to draw in the future. Some of them will require you to draw at least $50,000 and take $50,000 and refinance funds, which again, you can do with whatever you want to if you take that cash out. But again, they're just looking for a loan that has a balance from day one, and then you can carry it forward from there. All right, so let's talk about on our platform the types of lenders that do these short-term rehab loans and construction loans. So primarily the rehab lenders, we actually categorize them into 3 groups. We got our fast group. The fast group are those lenders that can close in less than 2 weeks. They typically have a streamlined valuation process where they've got a desktop appraisal. They've got maybe an appraiser on staff that takes, electronic data that they've pulled together. They may send in a quick inspector out just to make sure that, the house isn't just torn up inside, but they can do it without a full appraisal. Typically, their rates are a little bit higher, not hatefully higher, like I'll describe here in a minute, but typically they scrutinize the project a little bit more than others. They will take a look at your scope of work, which if you want a fast loan, you need to get that scope of work ready pretty fast in order to say close in a week. So again, they'll be looking for that. But what that fast group does, it enables our investors to be able to make cash-like offers, being able to say, you know what, I can close in 10 days if you give me this price. And we have a lot of our investors that are okay with paying an extra point in fees or maybe an extra percent in interest rate in order to get that 10-day close. So again, that group, we do a lot of business on that with that particular group. And those are typically the money source on that are typically debt funds. So the second group is what we call our mainstream group. This group typically gets their money from institutional loan buyers, Wall Street type, companies that will come in and buy loans, maybe insurance companies and that sort of thing. So this group typically closes, I would call it, in about 3 to 4 weeks today. They have what I would call the highest loan to cost. So if you're looking for the least amount of your money in the deal, the mainstream lenders are the ones you want to go for. They typically also have, the best rate and fee combinations and the lowest overall points. And again, those are institutional buyers. So if you've got 3 to 4 weeks to be able to do it, that's probably your best bet for getting, the best overall loan fit. And then the third group we have are called asset-based lenders. So this is the group that are what they are. They will take a lot of quirky property types. They will take a lower FICO score. They can typically close in that same 2 to 4 week. But again, they will take that odd situation, maybe a super small loan amount, those things that the mainstream and the fast lenders cannot take. They will come with the highest rates and fees that you can find. We have one lender that is going to charge 15 and probably 5 points. So in that particular case, a lot of you fall back in your chair and go, well, I'd never pay that. Well, I hope you don't have to ever pay that, but sometimes, the credit score gets down where you don't want it to be, but you still want to do business. So again, they're an option. They're there if it's necessary. So they are typically debt funds as well. And, those particular lenders, again, typically have more flexibility. So let's talk quickly about features with a short-term rehab loan. Things to look for and to watch out for when you're trying to select the lender that you're going to use. So the first bullet point here talks about interest. So some lenders charge interest on drawn funds, some charge it on total loan amount. So with our clients, if you've got a super large rehab budget or even a medium rehab budget, we're probably going to recommend that you go and work with a lender that provides interest based on the drawn funds on the deal. Because if you've got a big rehab budget and they're charging you on the total loan amount from day one, you're going to pay a lot more interest on that particular deal if you hold it for the full 12 or 18 months. So keep an eye out for that as you're talking about options with your lender, or if you'd like, we're more than happy to help you navigate through that. The second thing is, and we've talked a little bit about this, is max loan to cost. One of the features we have is, yes, we have lenders that offer 100% financing. Do we do a lot of it? No, we don't. Because typically what we found is that when those appraisals are coming in currently, those ARVs are not getting high enough to support that 100% financing option. So for those where we've got a lot of room, we will put them in that 100% option. But quite honestly, most of our clients, for the better pricing of those mainstream lenders, will typically be okay with an 85-100 or a 90-100 transaction with a little more certainty. So again, that 100% option exists. We offer it. We have it available every day. If you've got a deal that's a home run with the ARV, I think it's a great thing. If you've got the experience and are willing to go through the underwrite, for a 100% financing option. Again, it's something that a lot of our clients like as well. So let's talk about the next one, which is a very popular feature on our platform, and that is payments deferred to the exit. So we have a couple of lenders that say, you know what, we don't want to collect monthly payments from you during the loan process because then that creates a collection effort. We're just going to accrue it on our system. And at the end of the loan, when you refinance or when you sell that property, we are going to then collect that interest that's accrued. So, from an investor standpoint, they can say, I don't have to shell out that money. That's less money out of my pocket again during that particular transaction. And, I don't want the hassle of making payments either. So I like that because now I can pay that cost when I sell or refinance the property based upon that new higher value. That makes a lot of sense. Again, that particular set of lender options, tiny bit more expensive, but it's probably one of our most popular products that we have. The next item is deferred origination fee. So if you've got 2 or 3 points involved in the transaction and the lender says, you know what, pay that at the end too, again, that's pretty popular. Again, it conserves your cash. You have to bring less cash to close. And, that particular option is pretty popular as well. So again, we can talk you through, what that means and if those particular lenders are a good fit for you. The next one is no full appraisal options. We talked a little bit about hybrid appraisals, desktop appraisals. Those can move the transaction along a little bit faster, but it's not that meaningful in this particular environment. But those options still are out there if you need that fast close. The next one is the super fast close. We've talked about that in the lender types. So again, we have investors that are in various situations with each property that they bring in. One of them, they might need a fast close. The next one, they can wait the 3 or 4 weeks to get it closed. So again, we can customize which lender you go to based upon your individual need on each transaction. Refinance, rehab, or completion options. So back in the day, in early fix and flip time, whenever someone was in the midst of a project and they needed to refinance to get more money, it always felt like that project was in trouble and, and no lender would even touch it. We have a few lenders right now that kind of embrace that. They will check to make sure that there's not, severe stress on that particular transaction, but they will extend more money. They understand that material costs have gone up. They understand that timelines have extended because of things like COVID and permitting. So again, there are lenders that can help with rehabbing or refinancing and adding more rehab funds as long as that ARV value still makes sense. No experience options. So we have a lot of clients that come to us through the Bigger Pockets and Connected Investor platform that really are first timers. We embrace first timers. We are really good at talking first timers through the process and embracing them and giving them all the information necessary to help them select which lender that is the best fit for them. So again, that's something that we're really good at. As I mentioned previously, no or low excess liquidity options. So we do have a couple lenders that don't even get bank statements. As long as you show up at closing with enough money, they don't care that you've had it 2 months in your bank account. Again, these are kind of quirky features that some lenders have and others do not. And then we talked about asset-based options, meaning, sometimes odd properties, sometimes lower FICO scores, we can get that particular type of deal done as well. So that's a lot on short term. So I'm going to catch my breath. I'm going to take a drink and we're going to dive into the rental loans. All right. So the four keys to a great rental loan. You've now completed that rehab project or that new construction. Now you're ready to carry it into a rental loan. So typically, the majority of the lenders on our platform, if you've owned it during the rehab portion and are now converting it into a rental, they're going to want to make sure that you have it rented. So they're going to look for a lease. They're going to look for the first month's rent and security deposit. So we do have a couple that will do it even though it's vacant, but they're going to cut back your LTV a little bit. So back to a great rental loan. The number one thing for a rental loan with the best terms is a good FICO score. So what do I mean by a good FICO score? So all the lenders on our platform tier their FICO scores a little bit differently. But what I would tell you is that, to get the best overall rates and terms, some tier as high as 800 and they'll give you a little bit better. Some tier above 760 and you get their best price and best rate. Some tier above 720 and you get their best price. So again, it varies a little bit, but it is the number one driver of the rate you get and the size of loan you get. So if you want an 80%, 80% rate and term refinance, meaning a no cash out refinance on that particular fix and flip property, you're going to probably need a score of at least 720 or better. Again, and to get the best options, probably 760 or better. So again, a good FICO score is number one determinant of loan amount and the rate you get. The second item is they're going to make sure the property has a positive cash flow, meaning above a 1.0 DSCR. Many lenders are looking for above a 1.1 DSCR. So again, we have all that information. We can kind of tune in, the cash flows with you. So for those of you who are looking at this, the way that the DSCR is calculated is simply the proposed monthly payment on the new debt plus tax, insurance, and any HOA costs. So if you take those into account, got to be at least 1.0 or better, preferably 1.1 or better to get the overall best options from most of the lenders on our platform. The next thing is they need to make sure it meets the minimum loan amount. So many lenders have minimum loan amounts of 100,000. Other ones have minimum loan amounts of 75,000. Our most aggressive lenders in this particular area can do loans as low as 50,000. So again, make sure that that it meets that particular minimum loan amount. So in order to get a $50,000 loan, that property value's got to be around 75 or so in order for it to qualify. And then also, check the location. Is will the appraiser think that it's in a rural location? So many lenders won't do long-term rental loans if the property has more than 10 acres. Other ones if it has more than 5 acres. Other ones if it has more than 1 acre. So again, take a look at that, and if it's outside of a city center of less than, or it's around a city center of less than 25,000, we would always work to check with that lender before we would put that loan in process. All right. So long-term lenders actually also come in 3 categories for us. So as we look at DSCR lenders or rental loan lenders, the first bucket that we see is what we call non-QM or DSCR non-QM lenders. So these are typically lenders who are coming from doing consumer mortgages. So they're doing Fannie, Freddie mortgages. They're maybe doing VA, USDA, all of that stuff. And they are deploying resources from those underwriting groups into into their DSCR process. So we have not had really good luck on our platform with non-QM lenders because of the items that you see bulleted here. Typically, versus a private lender, they have a much more lengthy conditions list, much more things that you got to clear in the underwriting process, heavier verifications. The pricing is about the same. So between non-QM and the private lender, as far as what we see, and I think the big difference is that those particular loans may wind up in a different with a different investor or a different exit strategy for that lender, meaning they may securitize them directly or may sell them to a different group of institutional buyers. So the second group are the ones that we spend most of our time with, which are the DSCR private lenders. These are lenders that typically have done fix and flip loans in the past and are used to a much more streamlined set of conditions and have negotiated those conditions with their institutional buyers. So typically those lenders are structured in a couple of different ways. Some set up wholesale organizations where they work with folks like loanbids.com, and they work with other brokers and that sort of thing, or correspondents, and actually work to do some lighter processing and let relationships like loan bids do the bulk of the processing work. And other ones have a retail process, meaning that you would be working directly with an account executive at that particular lender, and they would give you a retail sort of experience, meaning they would be doing all of the processing, the ordering of appraisal, title, and the whole thing. So again, you find those in the non-QM world as well. But again, there are many wholesale lenders that don't actually have a retail operation or have a small one. So we get the benefit on our exchange of having super good pricing because that's the way that that they have structured their business very lean to do more. Again, their pricing is pretty much at parity with the non-QM lenders, and many of those loan buyers are either insurance companies or institutional buyers. So the third bucket of lenders, I would kind of group as some of those are the same as the private lenders, but have certain niches that they can play in. And some of them are completely different lenders that really specialize in that particular niche. And some of those features are some lenders can do properties that don't cash flow positive. So less than 1.0 DSCR, there are options out there. Yes, they're going to be more expensive than a traditional loan, but we can still get 30-year fixed mortgages on less than 1.0 DSCR. So again, if you've got a property, I don't know why you'd want to do it long term, coming out of pocket every month in addition to the monthly payment. But let's say you want something that you're going to dispose of soon, or maybe the rents that you're collecting are different from what the true market rents are, and it just shows up from an underwriting standpoint as less than 1.0. You can do the next feature is you can do higher LTVs at lower FICO scores. We have some lenders that can stick at 75 or 80% LTV all the way down into the mid 600 range on FICO scores. That particular set of lenders gets a lot of traction for those folks with sub 700 credit scores. Some lenders can do short-term rentals and underwrite them different ways. The ones that we like the best are the ones that use folks like AirDNA and the information that AirDNA provides in order to determine the overall cash flow expectation for that property. Obviously, a couple of years experience, with an established property is preferred by everyone. But many times, if you're buying that property for the first time and it's never been in a short-term rental, it's impossible for you to really demonstrate that history. Um, the niche lenders, as I mentioned, typically have a little bit higher rate and fee options. Again, it's not hateful in most cases. It's maybe 1% higher, maybe it's a point higher. So it's doable, and we do a lot of loans on these types of programs. In addition to that, depending on the lender, some of them securitize directly, and other ones have institutional buyers that buy these type of niche loans as well. All right, let's take a look at what the traditional long-term rental loan looks like. So typically on a 1 to 4 unit property, again, private lender long-term loan is typically for a purchase transaction, 80% maximum. Again, FICO score is important. Same for the no cash out refis, or some refer to them as rate and term refinances. And then for cash out, which most of our clients love cash out, typically 75 to 80%. Our 80% options probably gonna be a little bit more expensive and be limited to certain geographies, especially in this particular environment. Next thing is the majority of the loans that we do are, rates for a 30-year fixed are somewhere in the mid-6 to mid-8 range. Some lenders, to get to that mid-6, you're going to have to pay discount points or buy that rate down to get to that level. I would say our average high FICO score rate right now for a 30-year fixed, it's probably somewhere in the mid to low 7% range without buying that rate down. So lender points are typically around 1.5 to 2.5, and that typically ranges based upon the size of the loan. Also, the lender fees, again, those are those underwriting, processing, or whatever the lender calls them fees, and those typically run around $12.95 to $23.95 on a high. So again, we would work with you and try to find what's best fit for your particular property. And then again, you would have the cost of appraisal, title, and closing costs associated with that type of transaction. So for a rental loan, typically what we're seeing in the market today is a minimum FICO score of 620. Your LTV is not going to be great if you've got a 620 score, but we could probably get that particular loan done. And again, FICO score is the most important factor in pricing and loan amount. So again, and then typically the DSCR of 1.1 or better for most of our lenders, but we have options down to 1.0, still with great pricing, and below 1.0 with not so great pricing. All right, the varying features that you might look for when you're shopping for a rental loan is, again, loan to value is an important factor. Most of our clients, that's their number one thing. They'll even pay more in rate to get that more money out, that more cash out. So again, it's our job to kind of help fit that in, get you the most money possible at the best rate and fee combination. The next thing is the type of rate structure. We're not seeing a lot of it, but adjustable rates are a thing again. With the flat yield curve right now, the rate differential is not meaningful enough for many people to really jump on the bandwagon for essentially a 5 or a 10-1 ARM. So we're not doing a lot of those today. We're still doing most of our loans in 30-year fixed. But what we are seeing is, the fifth bullet point is we're seeing a lot of clients who traditionally would take a longer prepayment penalty if they had a good rate, look for options to make that shorter. So the typical DSCR loan we're quoting today is a 5, 4, 3, 2, 1 step down, meaning 5% first year, for the second, 3, 2, 1, 0. So it's 5 years long, but it steps down. In that particular instance, we are quoting a lot of folks a 3-2-1, a 2-1, and even some that say, I don't want it at all. And if they say, I don't want one at all because I want to refinance, we then also provide them some bridge loan options as well to see how they would compare. Because if you pay the money to buy out that prepay, that rate's going up. So again, we would provide those options. You've got rate and fee combinations. Again, what I would say there is that, let's say today's rates are, like I said, 7.25. We have one loan going right now where the client chose to do a small portfolio of properties. And they said, you know what? I'm not going to take a loan rate higher than 6. So we went to work and we found one of our lenders that would allow them to pay discount points. So they're paying 3 points, but they're going to get a 5.875 rate on that particular transaction. So we're in the process of doing appraisals right now with that particular client. So 5.875. I'm not telling you we can do that. He's got a really high FICO score. This lender, is allowing a rate that low. Most of our lenders have floors where they won't allow a loan to go down below around 6.5 right now. So again, we would check for options for you if that's what you want. But again, those types of things are possible for us to investigate for you. Next one is interest only and amortizing options. Interest only is what it is. I mean, it's essentially no principal going down of your monthly payment into the transaction. So we typically will use interest only options in a few cases. One where someone may have a debt service problem and they still want the maximum cash out. The other instance would be where someone says, I'm going to exit this property in a short period of time, and I don't want to pay more into it than I need to, because I'm going to be selling it. So that is an option. Generally, the pricing is a little bit higher. We're typically seeing maybe a 0.25% higher in rate for that interest only option. And then I already talked about prepayment penalties, but let's talk about single loan versus blanket options. For a while, blanket options kind of went away in the traditional sense. From the COVID period, they are starting to come back. And there are two types of those. I would call the one type of blanket loans ones that are a 5-year loan where it balloons after 5 years, or a 10-year loan where it balloons after 10 years. And then you have a second group of blanket portfolio loans, which are referred to in the business as cross-collateralized, where they'll just take a group of properties and your structure looks very similar to the structure of a single loan. They just group them together. So again, those are options. We typically don't recommend a blanket or portfolio loan for our clients that are doing less than 5 properties at a time. The cost savings are not worth the extra headache typically until you get to the point where you're at 5 or more properties. All right, so we're getting close here, folks. We're going to talk about how to position yourself. So, ownership structure. Before you apply for a loan, we've talked a lot about ways to position yourself with experience, liquidity, credit score. We have clients today who come in to us and they have a deficit in one of these areas. Maybe it's experience. Maybe they're a first timer. And the first thing we ask them is, do you have someone you can partner with who may be able to bring some experience or some liquidity or one of these major areas to the transaction? And before we apply, let's get that set up so you get the best rates and fees, you get the most loan amount that you can get by taking just a little bit of time, and maybe getting your credit score up a little bit. So think about your ownership structure, because from a FICO score standpoint, we have many long-term lenders who will take the higher of the 2 credit scores of 2 partners versus the lower of 2. So if you've got somebody with a 680 and another person with a 760, you're going to get the pricing with that particular lender for someone with a 760 score. It works out pretty good for our clients. And again, that's the secret sauce of what we can deliver to you, is those options that get you the best deal. All right. So we talked about experience, get that in order, your liquidity, get your credit score in order, and consider what your priorities are. Figure out before you come to a lender, before you come to us, what is it that I want? Do I want the standard things that most people want, which is least amount of my money in the deal at the best rates and fees? That's great. If so, you know, just think it through, and it may be property by property. You may want, a certain payment on a particular property. So just think through that when you go to apply and before you apply. And again, we can help you talk through those particular things. So just kind of wrapping up here a little bit. If you're interested, we have a website that we call REI News Now, and we post out there a rate survey. So you can check the most common types of rental loans, fix and flip loans, and what is our best rate on our exchange during that particular weekly period. So you can kind of see, this is a kind of a cutout of that. But if you go there, and it has a lot of breaking news, REI tools, it's got industry reports, but it also has this rate survey. So you can quickly check that every week or so, and you can kind of see where the best rates are on a particular loan type. So you can scan that QR code, it'll take you right to that site. And then lastly, if you want to know more about loan bids, you can check us out at loanbids.com. You can call us directly. That's our sales line, and talk to one of our account executives. Or if you simply have a deal you want to get a quote on, you can scan that QR code and take literally 2 minutes, provide the information, and one of our account executives will reach out to you quickly. All right. Blair, I think we're ready for questions, and I need a drink again.
Yeah, it looks like there is just one question. What loan origination and loan servicing software do you use, or do you recommend?
That's a great question. So we currently have 2 systems. We have a CRM system, which is kind of an obscure one, but we found it about 6 or 7 years ago, and it's called Como, Kommo. And we really like it. We have done great things with modifying it to work for our lead flow. So we take our client transactions through the contact process and proposal process in our CRM. And then we use the LendingWise system for our loan origination. So we are on LendingWise. We've been with them for just about a year right now. And we do like the system quite a bit. It really helped our process get refined. It helped really more than anything our interaction with the clientele. They have a way where we can automatically send them emails with links so they can upload documentation quickly. It has been really good for us.
Okay, the next question is, do you work with brokers?
So the answer is yes, but sometimes it doesn't yield a lot of benefit for that particular broker. So brokers, so we are kind of set up as a wholesale broker. So for many of the brokers that we work with, if they're happy with a point on a deal, yeah, they can do a lot of loans with us, and we can place them and we can process them and that sort of thing. So a smaller, newer broker that gets access to our network and is okay with 1 point, that's great. For those brokers that really need 2 points on themselves, what winds up happening is that it gets too pricey, and our clients don't accept the offers that are provided. So 1 point is great. I see your note there. So we'll be more than happy to chat with you. I'll get you connected with one of our top account executives, and they can talk you through how the process works.
So the next question is, are any of the companies using AI to determine if they will lend to you?
Not that I am aware of. We are currently not using AI for screening in any way. We're still doing it the old-fashioned way. We're talking to people on the phone and trying to talk through the implications of each deal. So the implications for us is something that we train our account executives to kind of work with you and flush out right up front. And when I say implications, what I mean is that set of factors that's going to drive your request to a certain set of lender options. So it doesn't mean a bad thing, but what it means is, okay, I've got this property in Akron, Ohio, and it's a low value property, and the DSCR is great, but it's kind of outside of Akron and maybe a ruralish place. So our folks are trained to kind of flush out those little nuances so we can say, okay, I know the lenders that can do a small loan amount, that can do ruralish type of properties. And, if need be, we will confirm that property location with that particular lender before we waste any of your time. So again, we do a lot of legwork for our clients to flush out, those implications and hopefully get you a set of options. And the beauty about our platform is we don't charge you anything for those options. If you let's say you like option 2 from one of the lenders, then we would go through the process. You don't pay anything except for typically the appraisal cost until the point of closing. And at that point, our fee is kind of embedded into whatever quote was given you. And so there's nothing in addition to that quote that was given you. So, and if you don't like any of the options, costs you nothing.
Okay,
What are
next
the
question.
okay? What are the fee? What are the fees we charge for our service? So that's a great question. So typically, we will embed in the pricing our wholesale pricing. Remember, we're on a wholesale model, so we do so much volume that we get highly discounted pricing from our lender relationships. So typically, for that, let's talk about a DSCR quote. So let's say I quote you 7.25 and 2 points for a DSCR loan. Of that particular loan, probably 1.5 to 2% of that will wind up coming to our exchange, because most of our DSCR lenders are giving us par pricing. But what we're trained to do is understand who's got the hot hand at any moment. So you could probably spend 3 weeks scouting out all of the lenders out there and who's got the best price on that particular day or time, where we know it because we're in that all day, every day. So we know, and as a matter of fact, we provide that information back to a lot of lenders and say, hey, you know what? You're about 50 basis points out right now. You better take a look at your pricing and sharpen a pencil, because you're going to get nothing from us. So again, we will typically on a DSCR loan embed anywhere from 1.5 to 2% into the overall pricing that goes out. But I will tell you that we very rarely lose on price.
I think that is all the questions.
All right.
Else?
Well, I hope this was of some value to you folks. Feel free to reach out to us either on our website, loanbiz.com, or through our phone number. You can reach us there. And, I think that, again, as I mentioned, we are on your side of the table as an investor, working for you with the loan options that we have. So it's a little bit different than a typical investor lender relationship. And that our responsibility is to get you the best fit in a deal.
Awesome. Thanks so much. Damon, we really appreciate your time today. Very informative.
All right. I hope this helped, and hopefully we hear from some of you.
Sounds good. Thanks so much, Damon. Everyone have a great day.